Hi folks, this is Tony Loton, and in this presentation I'm going to tell you about my new book on stop orders. Now I know what you're thinking that stop orders are really simple. They allow you to stop a loss, or if you're using a trailing stop order, to secure a profit. And we all know that stopping losses and running profits is a good thing. But there are many other things to think about when using stop orders, such as how tight or how wide to set the stops. How do you deal with price gaps? Should you be using stop orders to enter trades as well as exit trades? And how does your trading timescale affect your use of stop orders, whether you're a day trader, a swing trader, or a position trader? Okay, so here's one of the more original ideas documented in the book, which is using stop orders to free up risk capital for pyramiding additional investments. Let's look at the chart. In box 1 you can see that I buy at a level of 75. And at this point I have no stop loss order. So this is my point of maximum risk, where the most that I can lose is the full 75. I watch the price rise and then fall back to 150. At this point I make an additional equal size investment. And what's happened now is that if I apply a stop order at 125, then my original position, if it gets stopped out, will stop out for a potential profit of 50, which is the difference between the 125 and the initial investment level of 75. My new position, made at 150, would stop out at a potential loss of 25. So overall, across both positions, I stand to make a secured profit of 25 if both stop orders trigger. I can do the same thing again. Watch the price rise and then fall back to a level of 200. Make an additional investment and move all of my stops on the original position and my second position and my third position, move all of those stops to a level of 175. Now, when I do the maths, I can figure out that if all my stop orders trigger, at that point I'll walk away with a profit of 100. And then I can do the same thing when the price rises and then falls back to a level of 250. So what this means is, by the end of the chart, I've actually got 4 times my original investment working for me, and yet I've lowered my risk, and I stand to walk away with a guaranteed secured profit of 225 if all of my stop orders trigger at the final level of 225 that I set. Now, you might wonder, where does the money come from these additional investments? Well, if I was smart, then I didn't bet the farm in the first place, and I used just a fraction of my available funds, safe in the knowledge that I was going to increase my investment in this fashion as the price rose. Another way that I could do this is by using a spread betting platform, because the thing about spread betting platforms is that as you tighten your stop orders and raise your stop orders, the platform itself figures out that you're now taking less risk and gives you more funds to play with. Well, I hope this concrete example has been useful to you, and that it encourages you to go out and buy the book. Thanks for listening.